This is Anthony Valeri, Director of Investment Management in Wealth and Fiduciary Services. Thank you for joining us on this webinar, Assessing the Recovery, where we take a closer look at the economy and financial markets as they continue to recover from the coronavirus pandemic. Here's what we're going to talk about today. The U.S. economy bottomed in April and is exceeding low expectations as economic data has improved, financial markets have improved. We'll talk more about both. Global stock markets have bounced back strongly, but do expect volatility to persist for some time. This recovery is going to take time, even with the strong bounce back in the stock market thus far. So be aware, we do expect that to continue or return. The Fed has been very market friendly, but they reiterated their lower for longer message, where rates are going to stay low for a very long time. And then we'll talk about the virus and how we believe a resurgence of the virus is unlikely to result in the widespread lockdowns witnessed in March and April. So let's go ahead and get started first by taking a look at economic activity, and it has been picking up across the board. This is the U.S. Economic Surprise Index, which measures the degree to which economic data either exceeds or falls short of consensus forecasts. And you can see the bounce back there on the far right as economic data has improved for the most part better than expected in recent weeks. In fact, that indicator, the surprise index, dropped to its weakest level since the 2008-2009 financial crisis. It has since rebounded sharply as data has improved. This does not speak to the level of improvement. The economy still has much work to do to get back to that prior peak of February, but it does show you how economic data across the board has improved from the weakest points in April. Some of those data points, these are some of the more leading indicators, I think, and just more signs about how the economy is improving. First, when you look at travel, this is probably the most or one of the most depressed areas in the economy, and you're starting to see that travel is picking up ever so slightly. The TSA measures the amount of traveler throughput in airports and planes, and you can see that's down 80% from the pre-virus level, but again, slow improvement that the market is acknowledging and seeing light at the end of the tunnel. In the housing market, you're starting to see a strong bounce back as low interest rates have really started to translate into lower mortgage rates, and you're seeing an increase in mortgage applications. The housing market really beginning to benefit from lower interest rates and more activity there as well. Restaurants starting to see a little bit of a stall in activity. Again, this is one of the more sensitive areas to the virus. You'd seen a steady pickup since late April, but again, still down about 70% from normal activity. And this is one of the more recent and new economic data points to really gauge in real time how the economy is recovering from social distancing measures. So OpenTable releases data about in-person or in-restaurant dining, and you can see the improvement. However, in the recent days, in the recent couple weeks, it's stalled a bit, partly due to an increase in the virus, which is leading to some renewed safety precautions. This will be one worth monitoring, but probably one of the data points at the forefront of assessing the improvement in the economy. Overall, still nice to see that improvement, and again, we'll continue to monitor going forward. The area most hardest hit probably by the virus has been the labor market. You can see the decline or the drop or increase in unemployment. The 2020 recession, obviously the most severe of the post-World War II recessions, where we show the percentage of job losses in all of those recessions. So you can see just how much this one stands out versus prior recessions. And although the May employment report, which was released in early June, showed a nice bounce back in employment and a decline in the unemployment rate, there is still a lot of work to be done. To that point, more timely weekly jobless claims data, with the last release June 18th, showed that some of that improvement is starting to slow, and that will need to pick up again. So the weekly jobless claims data declined to 1.3 million people filing unemployment claims. That was a little weaker than expected. More importantly, continuing claims, which had seen a sharp drop in mid-May, haven't really changed much since then. And that sharp drop in mid-May was a reflection of workers coming back to work after virus lockdown restrictions were eased. But since then, there hasn't been much headway in reducing those 20 million or so people that remain unemployed. Still need to do a lot of work there to see a more meaningful push for the stock market after initial bounce. So we'll have to keep an eye on that one as well. But some initial improvement, much more to go. One area that has seen a very strong bounce back and is confirmation of the recovery is retail sales. And in mid-June, we saw the latest release, which showed a strong bounce back. You can see it on this chart here. Retail sales only down about 8% from February levels. And more importantly, this increase in retail sales is leading to upward revisions to second quarter economic growth as well as third quarter economic growth. Now, that upward revision to second quarter isn't going to do a lot. Second quarter economic growth is still going to be very weak, probably down 30% or so, but that down 30 is a little better than the down 35 to down 40 that had been forecast just over a week ago. And again, a strong bounce back is expected for the third quarter, as it sequentially is supposed to show some improvement. But more importantly, the consumer has been resilient, has bounced back, and that should help with the improvement in the economy on a going forward basis. Now, the other key aspect that's in play in the recovery here is global stimulus, which, although the Fed came out very aggressively in late March and early April, they have continued to be market friendly. We've seen some very robust stimulus in the US, and it has trickled across the globe. So countries across the globe have been not only aggressive with their central banks in terms of bond purchases, providing lending facilities, but governments around the globe have also picked up by providing stimulative economic measures. And this chart shows the total of fiscal and monetary stimulus as a percentage of GDP. And this is just really staggering when you look at a variety of countries and areas around the globe to see how much stimulus is in the system. It really is impressive. When you measure it all up, it amounts to 28% of global GDP or economic growth. That's more than double the response in the aftermath of the financial crisis in 2008. And central banks are still very stimulative. In mid-May, the Bank of England increased their bond purchase program. The Bank of Japan increased the potential size of some of their lending facilities. In the US, you have Congress talking about another round of stimulus, perhaps in July. So across the globe, you're still seeing a lot of stimulus, and it's likely to increase. And this is a key support for financial markets and a big reason why we don't think that stocks will revisit their March 23 lows. To that extent, it is worth noting that stocks are expensive when you look at simple PE ratios. Now, this is probably one of the more widely followed measures of valuation metrics. And if you look at the price to earnings ratio, whether it's trailing, and that's a look back at the prior 4 quarters profits, or versus the anticipated profits for the coming 4 quarters, you'll see they're both elevated. Now, the forward PE ratio usually spikes during a recession because profits are expected to be much lower. But my main point here is just to caution not to read too far into these metrics. Yes, they are showing expensive, but as an investor, remember, you're not looking at a 1-year horizon, which is what the PE ratio here looks like, but instead you're looking at a longer term 5 to 10-year horizon. And on that measure, yes, I still think stocks are a little expensive, but the fair value, in my view, on the S&P 500 is probably not too far from where the actual level is, but a little below it, probably 2,900 to 3,000 on the S&P 500. So still some, you still got to take these valuation metrics, especially the short-term metrics, with a grain of salt. And investors know 2020 is going to be bad, so they're sort of throwing that out the window and really trying to assess what is the longer-term prospects. And certainly relative to bonds, stocks make a more compelling longer-term alternative. In fact, in reflection of that and the decline in long-term bond yields, the percentage of S&P 500 stocks with dividend yields greater than the 10-year Treasury has risen to a new all-time high. So 71% of stocks in the S&P 500 have a dividend yield greater than the U.S. 10-year Treasury yield. So a pretty stark illustration of that. While the short-term prospects might be more mixed, on a longer-term basis, still stocks more attractive than bonds. Now, let me talk a little bit about breadth and momentum. Another reason why we do not think the stock market is going to revisit the March 23 lows is to look first at a surge in new highs. So as the market comes back, you can gauge the strength of the rally by looking under the hood and various metrics. One of those is looking at the percentage of stocks making new 20-day highs. And that measure increased dramatically in early June. As you can see on this table, in early June, we had 75%, 75.3 to be exact, of S&P 500 stocks making new 20-day highs. And when that's happened in the past, it is longer term positive. However, if you look at the short term, the 1 month returns, they're actually negative on average. So what that tells you is after you have a big surge, you tend to get some consolidation, maybe some sideways movement in the market. And June has seen some up and down days, some consolidation. So that is following a historical precedent. So the market is due for a pause after what has been just over a 40% gain from the March 23 low. But if you look out longer term at prospective returns on a 6-month and 12-month basis, they are certainly attractive, and particularly the 12-month return is what I think is a focal measure here. Historically, all of those incidents have been positive with an average return of 14.6%. So, and a key metric there again is that 100% of those cases has been positive. So when you do have that sort of surge in breadth, the new momentum, while it could lead to a short-term consolidation, the longer-term data is compelling. One more way to look at that is the rebound off the low, and this shows the best 50-day gains from a market low. And the rebound from the March 23 low through June 3rd, which is 50 days, is the strongest on record. And what does that mean when you look back at other rebounds off the low? And you can see the 1 month gains, similar story, not very impressive, roughly a flat market, as the market on average tends to digest those gains and consolidate a bit. The 3, 6, and 12-month numbers are all compelling, however. And again, on a 12-month basis, if you look longer term, 100% of those returns were positive, and firmly positive at that, with the weakest return in 91 at 8.7%. So again, yet another metric to show when you have that broad-based rebound, that breadth of strength in the marketplace, that is generally better for longer term returns. And although technology has certainly been more resilient and gotten a lot of the attention in the market, do be aware that the breadth of improvement has been fairly widespread. Mid caps, small caps, all benefiting, even if later compared to large caps, and even some of the more beaten up areas, such as financials and energy, coming back as well. So fairly broad-based gains that bode well for longer term performance, even again, if we are due for some consolidation. Now, as far as one other reason we do not think this market will go back to the March 23 lows, and also a reason why any decline is likely to be limited, is that the bulk of investors, institutional investors, are positioned defensively. This is a measure of short positions in the market, so speculators betting that stocks will go down. And you can see that this has happened before, where you have this big concentration of bets for stock market declines. And it's as big as we've seen it since 2015, early 2016. And before that, you have to go back to 2012. All three of these points correspond to improving markets, so that it tends to be a contrarian indicator. The more people are negative on the market, it acts as a floor as these investors put that money to work on any decline and or cover their short positions. So the fact that there are so many bets against the market is actually a short-term contrarian positive. Longer term, the fundamentals will ultimately dominate, but it does show where the positioning is in this market. So a lot of doubters about the rally, which historically has been contrarian, and the market usually rises in response. So don't expect too much weakness, or the weakness to be short-lived, in my view. And another way to show that here is checking institutional investors, fund managers to be specific, and their positioning in June. 2 of the 3 overweights at the top there, cash and bonds, are still significant overweights relative to the norm. And if you go towards the bottom, you can see that stocks are still a significant underweight. And this is not much changed from the month of May. And again, this is a contrarian indicator. And when the market or investors are positioned, the markets tend to do the opposite of that position. So equity is benefiting from a defensive positioning. And this also signifies that there's a lot of money waiting on the sidelines for any decline. So again, a couple of reasons why we think any weakness in the market is likely limited to a standard 10% or so correction. At one point in June, the market was down about 7% from the peak. So it bears watching, but just to provide some context on a potential pullback. Now, turning to profits, and one area I think the market still really hasn't gotten a grip with, but it is improving. Corporate profit estimates, when by the time they bottom and stabilize, you've usually seen a bottom in the market or at least a turnaround underway. Here is the estimates for profits in 2020, the lower line, and then the higher line there where it shows 163 is the estimate for 2020. What the market or forecasters are saying is that equities will be back to their late 2019 profit levels by the end of 2021, and that's a 2-year period. By historical comparison, it usually takes close to 3 years, about 2.5 to 3 years. So the market is expecting a fairly sharp rebound in profits, which might be a little presumptuous, and that could be a source of risk later on down the line. Still, this one is going to be a slow mover. We know second quarter profits are going to be weak. We probably won't get good insight into this until the third and fourth quarters of 2020, but a potential longer term risk for stocks that may not lead to, again, a big pullback, but certainly limited returns or at least bouts of volatility. So something to keep an eye on as we assess corporate profits throughout the years. Again, I would view this as a slight potential risk for equities longer term. Turning to the bond market, the improvement we've seen in stocks is translated to riskier segments of the bond market. I'd almost extrapolate that to basically even non-treasuries, but high yield bonds have benefited dramatically. They've also been a beneficiary of Fed bond purchases. The average yield advantage of high yield bonds just over 6%. Keep in mind the long-term average is about 5%, so a pretty big improvement here in the high yield bond market. I think that's about the extent of it, as defaults are about to rise, and the market will probably debate how much lower that yield spread should be. But notable improvement in high yield bonds. You've seen it in municipal bonds, which initially were impacted by the lack of liquidity in March and April, have seen a steady improvement. Other areas, riskier segments, even mortgage-backed securities, all those riskier segments of the market's improving, and we're seeing record low yields almost across the board here. So the expensiveness of bonds, or actually the lower yields of bonds, is again providing that sort of favorable tailwind to the equity market. Still think high quality bonds are an important source of diversification and downside protection, so we would not abandon that. However, if you're a bondholder and you've benefited from the rebound, that's a good thing. But if you, on a go-forward basis, the lower yields are going to lead to lower returns. So that's the sort of consequence of that strength. And do be aware that rates are likely to stay low for a very long period of time. Anytime the Fed embarks on a rate-cutting regime, and the last 6 are listed here, they tend to stay low for a long period of time, on average 4 years. Keep in mind the Fed first cut rates about a year ago, July 2019. 4 years would indicate 2023 is the first time they raise rates. And at the June Fed meeting, the Fed did announce that they expect to remain on hold through the end of 2022. So cash is likely to be very punitive for a while, even increasing maturity a little bit, given that backdrop from the Fed and the fact that it's unlikely to see any material change in interest rates for a long time. Should be a note to bond investors that, one, returns will be low, but may need to do more than that. Cash is not an option, and you should stay invested in a diversified portfolio of fixed income securities. So again, bonds not likely to be an attractive alternative here for equity investors for a while, but again, they continue to make an attractive alternative. Now, let me turn to the virus and a potential risk. Cases have increased in June. It's particularly in several states, and it's certainly garnered headlines as well as it should. So it does show the risk of a virus resurgence. Again, we do not think that we'll see the broad lockdowns we witnessed in March and in April. And the reason for that is it appears that our society has, one, gotten certainly more information about the virus. The recent uptick has not seen a broad-based increase in hospitalization, and that seems to reflect a better job of protecting the vulnerable. The use of masks, the use of social distancing has proven effective. So We do not expect a return to those lockdowns. However, it can still interrupt the progress of economic growth if some sort of restrictions are placed on the economy. So it does bear watching this recent increase in cases. Keep in mind, U.S. case growth as of June 18th was still only 2.2%. So important to keep the recent increase in perspective on an absolute number. Some states have seen a pretty big increase. So yes, a risk, important to keep it in perspective. But again, don't anticipate a broad-based lockdowns again to really cause problems for the economy. And if you look at the positivity rate, this also has stabilized. It shows, yes, testing has increased. At first, in May and early June, this was a good story as the positivity rate declined with increased testing, but that has plateaued. So it's a means to show that we haven't made as much progress against the virus here in recent weeks. And again, one more reasons to be mindful of the virus and a pickup as a potential risk or driver of equity market volatility. And then finally, one more source of risk that we look to in the markets, and this is longer term regarding the November election. Joe Biden has emerged as the frontrunner to win the election. You can see this reflected by the probabilities produced by Predictit. I should note that June is still a long ways off from November, and historically, these early polls have not had a good track record of predicting the winner. For example, in 2016, Biden was only a 20%, or pardon me, Trump was only a 20% probability to win the presidency. So still too early, but it does show what may be at work in the markets in terms of the choppiness in June if the market tends to react to a potential policy change or risk, as presumptive Democratic nominee Biden has suggested higher tax rates, both for corporates and individuals. And on that end, the Senate probability has shifted to win the Senate or control the Senate has shifted towards the Democrats as well. So the last 2 weeks have seen a pretty noticeable shift in sort of the policy risk expectations embedded in the market as a result of the November election. So again, very early. We don't want to make too much out of it, but it is something that is factoring into market behavior. Thanks for joining today. Again, I'm Anthony Valeri. Appreciate you joining us for our latest update on the economy and financial markets. We'll be in touch again in July with a mid-year check-in. Thanks again, and please stay safe.